Welcome to Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to understand what investors are thinking about right now and how that fits in with the right portfolio. So we just released our 2026 market outlook. And in the next 3 episodes, we'll go through every aspect of our materials and really how investors should be thinking about allocating assets in the coming year. Now, in this episode, I'm delighted to be joined by Raisah Rasid, who is our global market strategist based in Singapore, and we will discuss in a lot more detail about the macroeconomy, both the US and Asia, for the new year. So Raisah, thanks for joining us.
Thanks, Tai.
So let's start with the big one. Let's start with the US. How would you characterize the US economy in 2026? What are some of the risks you see for growth next year? And also, are we finally done with talking about tariffs?
Yeah, I think, in short, it will be a year of contrasts when it comes to the US economy. The first half of 2025, when it comes to growth, it is expected to remain robust. GDP is likely to expand above the post-pandemic average. And this strength is really being underscored by the personal incomes and tax refunds that US consumers will receive earlier next year. And this will likely rekindle some of the inflationary pressure earlier in 2026. But we do expect some of that fiscal support to fade, and you will see some of that job growth slowing down in the middle of the year. So in the second half of 2026, we do expect the GDP growth will moderate to a pace about 1 to 1.5%. Now, business fixed investment, will continue to remain a key driver of growth. So this part where we are seeing the unusual dynamic of very strong capex while you are seeing a decelerating economic momentum is not very typical. But the sustained demand for AI-related technology that will fuel higher imports, increase capital spending, especially among core AI businesses in the US, that will likely to continue. Now, you asked what the risks are around this. So there are a couple. So while the US growth is expected to moderate, and we are somewhat still constructive, but we are still very mindful of some of the risks. Now, the first of which is the amount that is being channeled into AI capex. We're seeing headlines after headlines about this. So there is a heightened expectation for the AI-driven growth, and that could really fall short if there is an earnings miss or a supply chain disruption that could occur next year, and this may lead to a pullback in capital spending. The second risk is that there is the additional savings that US consumers will receive from this refund could be saved, given that weak sentiment levels that US consumers are facing right now, and this really limits the potential growth tailwinds in 2026. And the third of which is the policy risks. Tariffs will still remain. Right now, obviously, we're in the midst of waiting for the outcome of the Supreme Court ruling on the legality of the country-specific reciprocal tariffs. So if the court does find that the president lacked the authority to impose these tariffs, we could see a shift to a specific sector-specific basis or a blanket tariff rate. But what we do know is that this could imply a renewed sense of uncertainty around trade policy. And finally, I think that this could translate to an upside risk is that we are going to experience the 2026 midterm elections towards the latter part of 2026. So Congress could potentially enact another round of fiscal stimulus, especially if we could see economic momentum really ease beyond the comfort levels of policymakers around the middle of the year. But this would be quite supportive for growth in the second half. So in short, a lot of uncertainty, still many opportunities.
Yeah, I think just listening to your sharing, I think we can describe also this as a 2x2 economy where you've got a year of 2 halves. The first half supported by tax rebates, obviously adding to potential momentum in consumption. Second half easing back towards the more sort of maybe trend or slightly sub-trend growth. And then the other two is effectively a 2-speed economy where the tech sector, AI, continues to fuel the investment boom. But the other parts of non-tech part of the economy, because of policy uncertainties, policy swings in the past, 6 to 12 months, they may still be relatively cautious, especially reflecting that through the job market. Now, with all that in mind, what do you think the Fed's going to do? The market's pricing currently about 75 basis point cuts between now and the middle of next year. Where would you think policy or monetary policy is going to be in 2026?
I guess the short answer to that is that we do expect that the Fed will bring monetary policy rate down to neutral by the middle of next year. Now, if we take a step back, we know that the Federal Reserve, they do operate on a dual mandate basis. So if you think about CPI first, US consumers have been relatively shielded from the effects of tariffs so far this year. Businesses have had to adjust how they operate, and this is partly due to the gradual implementation of tariffs, so they do have time to make such adjustments. So you haven't really seen the abrupt shift in behaviors from both the corporates as well as the consumers. Now, there was also a shift in imports from the higher tariff country to those with lower tariffs also, and that could really dampen some of that impact on CPI. Now, if you had to put a number on it, and assuming that we do not get additional fiscal stimulus, we do not get energy shocks, supply chain disruption, what have you, in the second half of the year, and if we had to quantify, the headline CPI is projected to rise to about 3.5% on a year-on-year basis by the middle of 2026, and that will really ease to 2% by the end of 2026. Now, it's very, very important to note that tariffs should be viewed as a one-time tax. So we are going to see a one-time shift in the general price level, and this is very similar to any sales consumer tax that we get around here in Asia. And I think what the Fed's going to look out for is if this will be translated to a rise or an anchoring in inflation expectations. So the Fed should be evaluating this. And so far, we haven't seen such shift with regards to this. So while you will see the headline inflation may drift further from the Fed's target, we do think that the labor market will be the primary concern and the guiding factor towards what the monetary policy rate path is going to look like. Now, on the labor market, we do expect some softening as we enter the middle of the year in 2026. Now, the data that we've gotten so far before the US government shutdown does show that labor demand is slowing. But what's interesting is that firing rates have not really picked up very discernibly, which tells us that the labor market, if we had to characterize it, it'll be one that is bending but not breaking. So on the Fed, again, just to reiterate the point, unless there is an unexpected rebound in employment this particular quarter with the September and October reports, the Fed is likely going to go ahead and really deliver the 25 basis points rate cut in December, with 2 additional rates cuts expected by the middle of 2026. That brings the federal funds rate to about the 3 to 3.25% range. Now, this is our baseline view. What are the risks around this? It is two-sided. So if the economy proves to be more resilient, then that path to that Fed's neutral rate of 3% could be slower than what markets are currently anticipating. Conversely, we are going to get that new leadership at the central bank in terms of the governor. And if this really does signal more dovish stance, even as the committee remains divided, that could really still affect that monetary policy rate path as well.
Great, thank you. So let's take a broader view of the global economy beyond the US. What about other developed economies? Are we expecting a similar growth trajectory where you've got a strong first half, softer second half? Maybe starting with Europe. We have already seen the European Central Bank cutting rates for the past 18 months. Clearly, there are also concerns about fiscal policies, both on the upside, for example, for Germany, where they can spend more, but also on the downside for countries like France or the UK, where they are under pressure to consolidate their fiscal position. What about Europe?
Yeah, I think when it comes to Europe, it's not really a tale of two halves, which is the story for the US. So while we are expecting some of that fading of US exceptionalism that really characterized the US economy over the past 2 years, we are seeing some more positive domestic policies really lifting growth momentum in Europe. Even more recently, we have received the European area GDP growth in the third quarter, and it is running around potential, higher than the ECB staff forecast, and the details do look quite encouraging. And this really follows on the back of that regional increase in the PMIs in October as well. That does suggest that growth momentum is still running above potential. Now, what do we expect looking ahead for 2026? Starting with fiscal, we have seen some of that buffers really being built from that pandemic era and the energy crisis with very healthy balance sheets, high saving rates in Europe as well. So taken together, this could really provide a sort of ammunition for both corporates and households to spend. Unlike the US, Germany is using its considerable fiscal space, which could really pose upside risks to growth. And this is only just beginning. I think that's very important to note as well, that this whole process on that fiscal story in Europe is really just beginning, especially when it comes to Germany. So the improving consumer backdrop alongside rising real wages, the ongoing transmission from that series of monetary policy rate cuts that we have seen from the ECB that will continually feed into the real economy, that could really guide growth momentum and really continue and sustain the above potential pace through next year. Now, as always, what will be the key risks when it comes to the region? Tariffs, headwinds could really impact sentiment levels. We did mention earlier that there's still a little bit of uncertainty coming from, what's the Supreme Court's going to rule, what could that mean? How would this really impact the fiscal multiplier on growth? I think that would be the key question when it comes to Europe. So while the fiscal package that's been unveiled by Germany is substantial, I think another key question that investors should ask would be, how will the funds be deployed? Another thing to note as well is that beyond Germany, other European governments are also finding it a little bit challenging to really balance what the electorates really want, and also the situation where they're dealing with very high deficit levels right now. So there are a couple of key concerns, I think, that we should still be very mindful of when it comes to Europe.
Yeah, and I think the fiscal discipline issue is going to come to the fore for a number of European countries, as you rightly mentioned. So some of them are balancing between what the voters want and also what the bond market investors are expecting. So we could see some volatilities there, but overall, I think low interest rate environment in Europe is likely to stay low. Let's move on to Japan. We do have a new prime minister in Sene Takachi, and I think she's pledging to some extent a more relaxed fiscal policy. Is that going to be executed properly? And at the same time, what does that mean for monetary policy of the Bank of Japan, where they have been trying to raise interest rates, but I think time and again that projection or that trajectory has been interrupted by a number of events.
Yeah, if we just take a step back and look at the Japanese growth momentum from a cyclical perspective, the recent data does show us that there is a sustained related tech demand that continues to bolster exports. And the current strength does look to be quite durable, especially when you look at the tech output in Japan when it comes to the data. Now, fiscally, as you rightfully mentioned, the newly minted Prime Minister Kaishi has really pushed for expansionary fiscal policies from a campaign until today. This includes plans to increase tax revenues through higher income taxes, measures to improve consumer sentiment through lowering subsidies of utility and gasoline bills. Now, at the current juncture today, the administration will likely finalize the package, the fiscal bill, later this month, and they would really work out the supplementary budget to finance part of the spending. I think the challenge, and this is very similar to what we've discussed in Europe as well for the markets, is to the extent of the fiscal package. While some of the investors are welcoming the relaxation of fiscal discipline, how will the Takaichi administration weigh this against the potential situation of excessive fiscal expansion, particularly given the elevated government debt levels to GDP in Japan, which is arguably higher relative to many other countries. So I think financial markets will be really monitoring this balance very closely. But the bottom line, when it comes to 2026 growth, the administration has expressed and committed its intentions to really support the Japanese economy that could fall prey to stagflation. So the sizable spending could really offset some of that downside growth risk that could come in 2026. Now, shifting gears to the Bank of Japan and monetary policy, there are key considerations that will really determine that rate normalization path, with the main one being that passage of the wage negotiations, which is what we've heard in the last Bank of Japan meeting. Now, on that, the initial momentum in the wage negotiations, the proposals, they do seem supportive of a hike in December, but the Bank of Japan needs to see more of that positive trend, especially in the auto sectors, which we think would be impacted most by the tariffs. So when we look back at the October summary of opinions, this really highlighted there were differences within the committee about the timing of the rate hike, but the board does seem flexible and has expressed some cautions towards policy normalization. All said, we do think that the Bank of Japan's leaving the possibility of the rate hike in December if the momentum warrants it, such as, you could see pronounced yen depreciation, but we definitely do know that we are moving towards that direction, whether it's in December or early in 2026.
So let's broaden this discussion out to the rest of Asia. Clearly, tariff has been a challenge that we've been dealing with all year round. And at the same time, export performance for some parts of Asia actually held up quite well. Now, the question then becomes into 2026, we may argue earlier on that tariff could be less of a threat. But could we see other drivers in growth helping out with the export driver? And what about the ASEAN markets that we expect to see next year?
Yeah, I think some of that export performance in Asia really speaks to the fact that there was some of that front loading activity because of announcements of tariffs. And we've discussed earlier that we could potentially see more of this headline. So there could be a lot more volatility as we approach 2026. So you could see some front loading and then some pullback when it comes to export performance. Now, what we're trying to focus on is what could be a more sustainable structural trend that could really drive activity, especially on the external front. Now, on that, I think investors may see the US as the epicenter when it comes to AI revolution. While that is true to some extent, there is a broader ecosystem that really involves Asia. Now, let's not forget out here in Asia, we have leadership and the high bandwidth memory chips in South Korea. 95% of the high-end semiconductor chips are produced in Taiwan. In ASEAN, there is that continuation of that data center build out that is really supporting the AI global cycle. But admittedly, the main concern right now for the Asian region will still be on trade issues that could really affect the export performance, especially given the very tight linkages between the US as well as Asia. So I think right now we're looking for, how sustainable will the AI trend be? Because that would really benefit some of the Asian economies. And we are seeing it in Japan right now. We spoke about how sustainable and durable that sort of tech exports output could be. So we are still pretty confident on the external front, especially given right now in some of parts of Asia, they are pretty much constrained by the fiscal limits. So there is a very tight limit for some countries, 3% of GDP when it comes to deficit, for example. Now, shifting towards ASEAN, we do think that ASEAN is really still emerging, being a hub for data centers. And that implies that insofar as the AI trend remains intact, this could continue to be a consistent avenue for growth, even if you're going to get that sort of headwinds that could come from tariff announcement. But again, the region's ability to continue to adapt to such changes will be very crucial. This will really entail more structural reforms, long-term planning by governments. So I think there's going to be a lot more important, particularly, again, when fiscal room is really quite limited, as well as external headwinds that could continue into 2026.
So finally, of course, we can't talk about Asia without discussing China. There clearly still some challenges facing the Chinese economy, the consolidation correction in the property market, deflationary pressure, and I think sentiment amongst consumers continues to be quite soft. You have seen some improvements in retail sales, but that's often coming on the back of government stimulus. How will economic growth evolve for China in 2026 in terms of policymakers' priorities? How do they balance between near-term growth downside risks and also trying to achieve longer-term sustainable growth objectives?
No, I think we think that China is at the critical point right now. So as you mentioned, the economy continues to grapple with the challenges that are very well telegraphed. Correction in the property market, deflationary pressures, weak domestic demand, sentiment levels. And Beijing continues to really adopt this conservative attitude when it comes to fiscal policy. So as investors continue to wait for the fiscal bazooka, as was often mentioned, it does not look very likely. But I think what's important to note is that policymakers will stand ready to come in if economic growth momentum do fall quite significantly, and they could come in with monetary policy easing, whether via through policy rate cuts, triple R cuts, and fiscal loosening. So we could see a potential step up in bond issuance. As you mentioned, we have seen, at least in the last couple of quarters, that recent shift from cyclical to more structural support. This was reiterated in the commitments in the 15th the FYP and also the anti-involution campaign. And this really reinforces policymakers' commitment to growth sustainability. So on that structural piece, the anti-involution campaign that addresses issues of overcapacity in certain sectors, that has obviously dampened industrial profitability in some of the sectors in China. And the recent communique from the 15th five-year plan that will likely continue to guide the country's development from 2026 to 2030 that reiterated that long-term commitment for some of their policies, whether it's technology, etc. So what the policies policymakers have emphasized is that they will continue to commit towards upgrading manufacturing processes, the prioritization of self-sufficiency, especially when it comes to technology, and really push that frontier to the dominance in advanced technology over the next 5 years. So these reforms and measures will likely be very supportive for certain sectors such as technology, advanced manufacturers sectors, especially if external headwinds such as tariffs are going to continue to be a common feature, not only in 2026, but beyond. So all told, while growth momentum is likely to slow in 2026, this to us is a product of really the policymakers balancing near-term goals when it comes to growth versus sustainable long-term growth. And they would do this through that policy mix of both cyclical support, and that would be monetary and fiscal, as well as structural reforms. So we're going to see that continuation of the anti-involution campaigns, etc. So it's really that balancing mix when it comes to China.
So if I just summarize all your thoughts on the macroeconomy, I think there are three things to watch out for. Number one, artificial intelligence and development continues to be a linchpin for a number of economies. Of course, the US, and we also see that in Asia. We're still optimistic, but obviously any corrections, any adjustments in that field could provide some growth shocks to the global economy. Number two, fiscal policy continues to be another key pillar of support. We are more optimistic, for example, in Germany, which they do have a lower level of debt and a step up in fiscal stimulus or greater spending on defense could potentially provide more growth momentum to the German economy. But you can't say the same thing with some other European economies, such as Europe, such as France or the UK. And meanwhile, Japan, again, the new government could well be stepping up its fiscal support. And the question then becomes, how will bond investors react to that? And finally, on monetary policy, I think the overall global environment continues to be one of further easing. Not every central bank will cut rate next year, but clearly the Fed is still very much on an easing path, and rates are likely to stay low, if not lower, on the back of softening growth around the world or dealing with downside risk to growth. So, Raisah, thanks for joining us today.
Thanks very much for having me, Tai.
And also, thank you for joining us on this episode. In our next episode, we will discuss more on equities and fixed income when it comes to the market outlook for 2026. So please join us. If you enjoyed this podcast, please subscribe and consider sharing with your friends and colleagues as well. I'm Tai Hui. I'll see you next time to discuss what's on investors' minds. And meanwhile, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.